The vast majority of dollars were government sources. That's usually never a good sign.
Welcome back to another episode of Tank Talks. On this week's episode, we skip the interview and go right to the weekly rundown show with John Ruffalo. All right, John. Well, welcome back to the Tank. The summer is flying by, but there still seems to be everybody at their desk getting a lot of work done here. We got a lot to cover, so let's jump right in. First thing to cover is Radical Ventures' newest venture fund raised. $800 million is the number, creating one of the largest funds dedicated to AI. This is their third institutional fund that says it will focus now on growth stage AI startups rather than building off their two prior earlier stage funds. Obviously, the biggest name that has come out of the Radical portfolio today would be the Cohere name. And they've received, obviously, investments from some large pension funds, including CPP, which has committed $75 million to this newest fund, bringing their total commitments to Radical at about $204 million. And they've raised $550 million last year and a $350 million 2019 fund. So I guess thoughts around this, given that they have been one of the leaders in the AI space here, especially in Canada. And where do you think this takes them now that they're in the growth stage mindset of investing with almost $1 billion under this new fund?
Well, first of all, huge kudos to Jordan and team. That's a large amount for relatively early in their history. There's a lot of funds that start off with either a venture and then move to growth so that they could do follow-on rounds. But if there was one space right now where it's absolutely critical to do this, it is in the AI space, largely because the amount of capital that's going into the space is so large. And biggest risk that you have as a VC investor when there's so much capital consumption is you get crammed down by the next rounds of investors. And this is a great way to cherry pick the ones that you believe have the best opportunity forward and to really protect your pro rata through. So I think it's a great strategy for them. It's also a binary strategy. So, in the VC growth game, you can't play it safe. So it is an all in on the AI space. It could work against you if the prices are overinflated and overhyped. But, I think it's fair to say the long-term prospects for the space of AI, I think everyone would agree it's generally extremely positive. The question really is, how hard do you go at what time? And are you going to get the requisite returns? But again, kudos to them. And I'll be excited to see how they operate.
Yeah, absolutely. It's a fantastic flag for them to be waving, obviously, with founders, of large tech companies, obviously backing them as LPs. You've got former Google executive Eric Schmidt, AI luminaries Fei Li, and Jeffrey Hinton, obviously joining the team as well and investing. I think the question, though, is what does growth stage really mean in AI? Because if their seed rounds are being done at 100 to 200 million, is that growth stage? And you're buying 10% there and then waiting for the unicorn valuation to write your bigger check. I guess the question is, what will growth stage really truly be defined as? Because I don't really know. And then the other question is, how do you still, even with almost $1 billion in a new fund, still compete with the corporate venture arms that have unlimited capital to write checks into these companies and have different sort of underwriting criteria, if you will?
Well, you know what? So that last point you made is an interesting one. I don't know if you gone through it. The Canadian Venture Capital Association had released their 6-month summary of VC returns, and a few pundits had commented, "Oh, you see, things are still okay." Well, first of all, look a little bit deeper. Two massive observations. The vast majority of dollars invested by Canadian sources were government sources. That's usually never a good sign for long-term health. But number two was the amount of VC dollars done by corporates. Out of the two biggest funders of private funders, I believe was NVIDIA and it may have been Salesforce. It was either, I think it was both of them, that were 10 times the next highest Canadian-based VC. So the problem is you are competing in this space against a Google or a Microsoft where they're subsidizing these investments off of their massively profitable businesses, which makes it even more challenging to get the requisite return profile. So I do agree with you.
Yes, there was the CVCA report that was released, but really what's more interesting is the Carta report that was released, covering over 45,000 startups on the Carta's platform for their July 2024 data. So let's cover some of this and let's dig into some of the details. So some of the areas they covered were, analyzing trends in pre-seed funding and highlighting the growing importance of safe notes and convertible notes in financing now, the discernment between priced rounds and obviously convertible or safe rounds with valuation caps on them. And then also talking about some of the stuff around emerging managers. Here are some of the highlights, John. So in Q4 2021, that was the highest recorded funding by companies on Carta at $68 billion. And in Q2 2024, the number is at $16 billion, which is sort of back to the similar levels we saw back in 2018, 2019. But the only thing to note is that there are way more companies on Carta now than there were back in those times. So that is something I felt was quite interesting. Now, the other thing was that no stage was really being saved right now on capital invested. Obviously, the worst stages are Series C and Series D rounds. Obviously, with the IPO market really not moving that much, we're seeing those rounds down 45% and 60% respectively. Seed was only down 28%. But the interesting thing too was that the time happening between rounds is obviously expanding. We used to see in the 2021, 2022 bubble, rounds were being done only 12 months apart. Now we're seeing rounds being done 2.5 to 3 years apart. So doubling from the time you get from C to Series A and then beyond. Now, C to Series A is the biggest problem, where those rounds should be taking 12 to 18 months or taking anywhere from 24 to 36 months. So that is also very hard because then the earlier investors like ourselves have to make sure we have enough runway to get to the next round of funding. So that's also very interesting. Now, the other thing I thought was quite remarkable was seeing how only 10% of A's were raised in the first half of 2022 have made it to Series B so far. 10%. What are your thoughts on that, John?
That to me was the most startling statistics. So now the problem with the statistics beyond that, it's all based on survivor bias. It doesn't really give you the truth of what's really happening. And, we met with the head of Carta Insights on Monday, and he had said the biggest observation is the number of companies that are actually going bankrupt or just basically stopping to operate. And the problem is there's no clear data because there's no message given. But they just all of a sudden don't get any further information. And I think that's going to be the big story of the lack of financing, particularly beyond series, beyond the seed series. At the other end of the spectrum was another story, exactly what you had said. The worst tanked valuations were on the late stage Series C and D. Two observations. Did you see the corresponding number of structured deals and bridge deals going up astronomically? And what they started to show was how many of the last financings of the preferred shares were beyond a one-time liquidation preference. So that's just telling you that a lot of deals are just being supported by the existing investors. And the reason why you are experiencing the biggest drop in the valuations on the late stage is that the stage before it, 2020 and 2021, the valuations were so out of this world that they're all being adjusted down. And I believe, if I remember, it was about a 77 or something like that percentage decrease in the value. It was a massive number, which basically says the average company was probably valued at about 200% of what its quote, real value should have been in those 2 years. So that is now starting to filter through the system.
Yeah, so let's fill in the blanks here. So Series C was down 45%, Series D was down 60%. Now, the 42% of price seed rounds in Q1 were bridge rounds, which is kind of crazy at seed. And same for Series A, where almost 40% were bridge rounds. And at the B's and C's level was 30%, around roughly the same. Now, the other part you mentioned about the wave of shutdowns, right? So in the first half of this year, 474 companies had shut down versus 441 companies in the second half of last year. So we almost all over 1,000 companies between last year and the first half of this year have already shut down. But as you know, when a company shuts down, they don't let Carta know. They wait a full year to wind things down, and then they have to file their final tax return with the either U.S. government, if it's a U.S. company, or Canadian government, which will then happen only in the following year. So that's also why the numbers are a little bit delayed. Now, the interesting thing you mentioned on was the convertible notes here are sneaking back in between priced rounds with a higher liquidation preference beyond 1x. So for our listeners who don't understand, is when you give money into a company as a preferred investor, you typically sit at the top of the stack before the money gets paid out on a liquidation event. However, if new investors come in, they go above you in the waterfall, but also if they have a liquidation preference higher than 1x, they get that 1.25, 1.5x payout before the next person in order gets their payout. That the worst of the worst is participating preferreds. And we won't get into that right now because it's a little bit longer of a conversation, but those are the worst of the worst. So those are happening at the Series C or later stage. And I think the reason we all agree on is the IPO liquidity is just not guaranteed. And so therefore you need to protect yourself for the amount of time it's taking for companies to get out into the market. And then the most shocking thing to me, I thought was, I guess M&A is just completely dried up for companies at Series B or later. The most M&A we're seeing is at the pre-seed, seed, and Series A stage. And I think that's probably because there's a lot more stock being issued, acqui-hires, and less preferred stacks to cover off. What do you think?
Yeah, no, I agree. I see this in Canada as well. I think on the later stage, the problem is the valuations of the prior rounds are so high. And what happens is when negotiations are going on, people are trying to at least protect the values of the last rounds. And potential acquirers are saying, well, no, the value is not there. So they have the benefit of waiting. So that just tells me that people are just sitting and waiting. There really is, in many cases, no reason to hurry. That if companies are struggling, particularly from a cash flow perspective, just wait. And then, the company may go out of business and you can just take things, largely for free. But when it's on that early stage, you're absolutely right. It really is the acquire hires that are going on. The one big example, which was astonishing, was the Character AI deal for $2.5 billion, which I'm not sure we really understand what that deal was. But that was probably, the craziest acquire hire. But I think that is a lot more easier to do, particularly with specialized AI talent.
Well, also with a lot of corporates with their hands in the cookie jar, probably, trying to vie for their own saving face, maybe for their jobs, for someone that put their neck out on the line.
It's a great story to the board when they ask you, what are you doing on AI? Exactly.
Just switching gears here, giving you your red meat T-bone steak, extra rare, is the Canadian government's proposal on this Canadian Entrepreneurs Incentive, the CEI, which was part of this broader overhaul on the capital gains strategy, which most of our readers are obviously brushing through and not realizing much has changed. But let's just go through some of the changes that were announced here, John. So the CEI's rollout period now will be shortened from 10 years to 5 years, with a maximum benefit of 2 million Canadian in eligible capital gains achievable by 29 instead of the 2034 number. The other part they did was they lowered the ownership requirements. The minimum ownership requirement for founders has now been reduced from 10% to 5%, and the minimum engagement period has been reduced from 5 years to 3 years. So they've expanded this eligibility portion for the CEI, obviously to include more small businesses and obviously startups and qualified farming and fishing properties. Everyone was obviously hoping there was going to be a lot more alignment with the QSBS and the US model, which we are not getting. But obviously, there's still a lot of criticism to be put forth on this CEI initiative. So with these new changes, do you believe the government is actually genuinely fostering entrepreneurial growth in Canada, or are they still too restrictive here?
My reaction was a collective, shrug and so what. Let me separate the issue for two different groups. One is the the tech entrepreneur and one are the investors. Okay. So on the tech entrepreneurs, as I had said from day one, it's about the narrative. Taxes don't drive the building of companies per se. The great ones, the ones who really want to change the world, they're looking at billion-dollar exits. What this change said to them was, we really don't care about the risks involved in you building your business. We don't care about the stock options on you attracting people, which, by the way, gets zero impact of those rules. So it's just nickel and diming. I think when you asked me in April, I said to you that there was a between 0 and 1% chance that they were going to reverse the capital gain change, but there was about a 50% chance that they were going to improve the entrepreneur initiative. So I was expecting this. Yes, it's a little bit of cookies to make you feel a little bit better. But at the end of the day, the real issue is going to be availability of capital. So from an investor perspective, it obviously does nothing. And I don't care what anybody tries to guess on. Fundamentally, when you tax capital, it's just a mathematical equation. This is not a political ideology, folks. Get your calculator out. When you get taxed more on an exit, there is less money to redeploy back into the next investment. It's as simple as that. And so there will be less capital coming from private capital sources. And fundamentally, that is the real issue. And that it's going to hurt the entrepreneurs in a time when, we're already seeing, whether from Carta or from the CVCA, the numbers are going to keep on coming down and it's going to get worse. This is the fundamental issue. So, at the end of the day, still not going to back off on that. The taxes are too high, generally speaking. And fundamentally, if you believe that government is better suited to redirect and reallocate where scarce resources go to, so be it. That's your ideology. But I fundamentally believe that entrepreneurs and investors on a private side are the most effective resource allocators, and why I continue to not believe this is the right direction to go.
It's surprising, though, even as their budget numbers that they calculated that would come in from this deadline on the capital gains increase fell way short. They still were not able to sufficiently address the issues around employees, angel investors, and early stage investors on the incentive part of CEI. They completely left it off the table, and it's not going to change anyone's opinions probably on how this plan will move out going forward in terms of capital investment, resources required to stay in the game, and for the ability for the investors who take the risk to want to stay in this country and put more capital to work in this country. So I think we'll have to leave it at that. I think we're all on the same page here, John. One thing I wanted to talk to you about also was that, I don't know if you saw this, but there has been some interesting action happening in the purchasing of NVIDIA chips going to China by using middle brokers to get over there. So I don't know if you heard about this, but there was a $120 million order placed on NVIDIA chips that the U.S. export restrictions obviously do not allow. So in order for them to circumvent this, they used a Malaysian broker who set up a shell company to disguise the Chinese buyer's origins. And this is part of a growing and sophisticated network of chip smuggling operations, driven by obviously increasing U.S. restrictions on NVIDIA's AI chips. What do you think this will do in terms of the AI race? Do you think other people will supplement it? Do you think this will impact NVIDIA's future growth as the U.S. has, I think, subpoenaed NVIDIA as well? Do you think regulatory restrictions are going to sort of stymie a lot of the hype around NVIDIA this year?
Well, first of all, there are existing U.S. laws where you could attack the middlemen in these scenarios. We see this with sanctions on Iran or on Russia, and you're just as guilty. So the U.S. will not take kindly to folks doing this, number one, and they'll blame everyone in that supply chain. But number two, I've called this before, and you could see it. This is a cold war of chip making. NVIDIA's monopoly on the AI chipsets is certainly troubling, not only to various countries, but also to organizations who are their customers, because they can charge monopolistic prices. You just saw yesterday, I guess there were some secret talks between SoftBank and Intel, where SoftBank was working with Intel to create an AI chip, and they wanted to leverage U.S. Government dollars to build fab plants in the United States. The talks fell down. I can bet you that AMD is very aggressively looking at this as well. And I go back to the rule of three for infrastructure. There is room for three strong players in the space, and I think that this is more incentivization for the other players, particularly AMD and Intel, to compete against NVIDIA. And I will not be surprised if you see very significant government backing in order to do this.
It's quite interesting. The monopoly conversation continues to come up, especially in government and going into an election in November in the US. With Google losing this landmark antitrust case, though, it is one of the biggest antitrust showdowns in the last quarter century, obviously. This case, though, as it gets appealed, obviously, by Google and seeing if the ruling can be upheld, I still don't know if it's going to shake up the internet as much as the government wants it to. Are people going to just all of a sudden get a pop-up window on their iPhone when it says, which browser do you want to use? It's going to have DuckDuckGo or Start Page or something else. And then all of a sudden they're like, no, I want to use Google. Let me use Google. And then the monopoly grows back, organically from consumers' free choice. I guess, how much can the government really impact it, even if consumers want it that way?
Yeah, I mean, this is reminiscent of the late 1990s against Microsoft. And I believe, if I recall, it was triggered when Microsoft was going to acquire Intuit. And the government finally stepped in, despite the fact before that we had the browser wars and Microsoft, how they buried Netscape. The one that I suspect, again, I have no inside knowledge at all, but I'm hearing about if they separate the Android operating system into a separate company, that could be very damaging, because now all of a sudden Google, yes, I agree with you, could maintain their dominance, at least right now on search. But again, if with Gen AI operating on the Gen AI, ChatGPT, you combine it with RAG, it really becomes the super search, and Microsoft dominance there could be at serious risk there. But to lose Android, where they have, grips on, 90% of mobile operating systems? I don't know. It's a big number. That would be a big blow to them. And I think that's the scary part. And that's where I see the separation potentially happening.
I don't know. I think that even if they structurally separate the two, or from a corporate structure, they're still going to have business alliances together, and they're still going to do things together. And look, no one forced Apple and Google together. Apple benefits from the $26 billion they get paid with 99% margins on that, and Google benefits because they make a lot of money from all the data they collect and use it for their ads business. So I just don't understand why the monopolistic mentality from where government thinks they can insert themselves, like they did with Microsoft, where the Department of Justice became basically project managers at Microsoft, stymied tons of innovation, put handcuffs on the company, and then eventually they came off and let them run free. And look at the innovation we have coming out of Microsoft. So I guess the question is, does monopolies really hurt the consumer? Yes, it probably does in certain ways. But if consumers elect for that to be their choice, then what can you do about it? So we'll have to wait and see.
If I could just comment on here, it's interesting when Microsoft was absolutely fearful that they were going to separate the operating system from the applications for Microsoft. So Microsoft was in a holding pattern. Many believe that the attack on Microsoft enabled more competition, and the biggest benefactor was Google. And Google emerged. Right. So I am wondering whether they're trying to take a page from the history books and saying, hey, wait a minute. If we slow down Google and distract them on this, does it enable more competition? And the interesting article that I read on this, it was about 2 weeks ago or so, or Mark Andreessen wrote an excellent article on big tech versus little tech, and how this little tech, like Google was spectacular, but there's a point when they then start to actually, shut the door behind them due to their success. So balancing that out and having the vibrancy of the digital economy, it is a tough nut.
It's a very good argument.
Where I'm sympathetic is where the government granted a monopoly and it's abused. Those are clear lines. When somebody develops a monopoly because they were so goddamn good at their product and business, it's a little bit of, okay, so you're penalizing tremendous success. So yeah, it is interesting.
I just wish the government would do the same things to the fabs, like the Boeings of the world, the Lockheed Martins, and let the door stay open for like SpaceX or a Starlink or something like that. You know what I mean? So they don't look at it the same way. That's all. But you know what? I'll have to save it for another time, John. Thanks for joining us in the Tank today, John.
Thank you.
Hey everyone, thanks for tuning in to another episode of Tank Talks. We hope you found today's conversation as insightful as we did. If you're enjoying the show, we've got 3 quick things to ask of you. First, hit that subscribe button on your favorite podcast platform so you never miss an episode, whether that's Apple Podcasts, Spotify, Google Podcast, or YouTube. Next, follow us and stay up to date on upcoming episodes and behind-the-scenes content on social media with Twitter, LinkedIn, and Instagram. And lastly, share the love. If you found value in today's episode, share with a friend or colleague who'd benefit too. Your support helps us bring in more amazing guests and keeps the Tank Talks engine running. That's it for today. Until next time, keep disrupting and innovating.